Hello everybody, welcome to Online Trading Academy's webinar. Today we're going to have an interesting discussion about expectations versus reality. Now I'm going to start off with a real quick story about my childhood. I know it sounds weird to go back and start about my childhood, but when I was 9 years old, my father had an S&P stock guide, and I just stumbled across it. I was going through his stuff, and what was great about the way my dad presented it is it was very even-keeled. It showed me a lot about the reality of the markets, and he never sensationalized it. He says it's a way to grow your wealth. I wish more people felt that way, because what's unfortunate is there's so many unrealistic expectations out there, and I think there's also some unrealistic negative expectations. I'm going to go through a lot of that, show you the reality that I've seen not only from my personal trading experience as well as from all of the instructors at Online Trading Academy, and we've got well over 130 right now at this point, so pretty excited to have a lot of feedback. And hello to everybody out there. I see we've got a very diverse group, a lot of people from all over the world. I don't know your trading backgrounds out there. I'm assuming all of you are to some extent involved in the financial markets. If you are not, that's great as well. I posted on Power Trading Radio, I said, I hope that the people that are traders bring in their naysayers, bring in their family and friends who say, you shouldn't get into the markets, it's dangerous, or people think it's get rich, so we can bring people back down to reality. So now let's get started. Some of the major things we need to understand when we look at how our brains are wired is there's a sensationalism. Look at the way we watch our news every single day. If the first 10 stories are always something so sensational that you can't turn away from it. The financial industry has a wonderful way of sensationalizing how much wealth you can accumulate, right? They show all these financial advisors and brokers with Rolexes and Dolce & Gabbana ties and Fendi shoes and fancy cars. Well, that's one side of the equation, and generally that's the broker, not the average trader. So they'll sensationalize the wealth. The other side, for many of us, are our family and friends who hear what we do and they say, oh, I'm a trader. And they say, oh, God, why would you be so stupid and be a trader? You're going to lose everything. Nobody does that. It's a gambling thing. So that we have to find that medium between the unrealistic expectation that you're going to be filthy, filthy rich, and the other side of the coin, which is you're just going to lose everything and be broke. And we'll look at a lot of the relationships there. So Online Trading Academy did several polls, both on our Twitter feed as well as our Facebook page. And we'll start off with that poll right now. The first one we said was, I am interested in trading and investing as a way to blank. Surprisingly, I actually thought it would be more on the retirement side, but a lot said enhance current lifestyle. 66%, we had 22% say assure my retirement, and then 12% other. Well, let's look deeper into the first expectation here. The first one that we come across is this expectation that trading is a way to get rich quick. They told me that I probably shouldn't spend, throw names out there, and I won't do that, but there are a lot of industry experts, hence my sarcasm, that took huge chances, made money on a couple of them, and now claim to be filthy rich. And I'll give you an example. There are ways that you can go and take a flyer. And what I mean by a flyer is these guys will go out and buy $50,000 or $20,000 worth of the cheapest penny stock that you could imagine. And they'll do that in separate accounts and do it in 10 or 12 different accounts. Out of those 12 accounts, one might hit. And all of a sudden they use that one account and say, see, I'm a great trader, I'm a baller, look how rich I am off this. The reality is they lost in all other 11 accounts and they're probably a net loser. So the attitude that trading is a way to get rich quick needs to be squashed right away. The reality is that trading is a way to grow your wealth, although it will take time. Those of you feeling that you're going to take $1,000 and throw it into a Forex or an options account and by the end of the year have $100,000 in there, that's an unrealistic expectation. And I'll talk about average annual rates of return, because wouldn't realistic be we're using the market to grow our capital? So let's look at the markets from 1948 to 2019. As you can see here, it's up, right? We've gone from 1948, we were down right around 100. Now we're over 26,000. We're almost over 27,000. Yes, Joseph says that's pump and dump. Yes, there's a ton of that pump and dump out there. The average rate of return from that period of time, 1948 to 2019, is 7.1%. Okay, that's a long period of time. Let's go more recently. And if we zoom in a little bit and go to 1981 to 2019, it's 9.5%. So the rate of return has gotten a little bit better. Well, let's just say the average for our discussion here today is about 8% rate of return. So when we're looking at some metrics, when I look at compounding interest, when I look at long-term growth of capital, we'll look at 8% as kind of a realistic number. Could we get 10? Could we get 12? Could we get 15? Sure, we could. Could we sustain 15% over the course of our lifetimes? That becomes more of a challenge, but meeting the 8 would be rather simple because that's what the market gives us. Those that say that they could get 100% rates of return a year for the rest of their life, that's a little bit unrealistic. So now let's take a look at the other expectation. And this is the one that I love. This is why generally when I go out into social settings, I don't talk about my work as being a trader because I just don't want to listen to these people that are naysayers and negative people that say traders lose all their money. That's the other expectation, is that those who trade lose all their money. I'm sure that some of you right now have family or friends or acquaintances who say that. Get rid of those people. Don't involve them in your financial doings because they'll just bring you down. The reality is this, and I have seen this not only in my personal account, but also in hundreds and hundreds of accounts of students on the trading floor that I saw back in the late 90s, and also students I talked to. Your account value will generally look like this. If you are just starting out, you're going to probably lose money at the beginning. Why? Because you're still learning how to do this. You're still trying to figure out how to do this. So for most people, it will be this vicious slide. And you'll notice on this curve right here that over time, the slope starts to slow down a little bit, right? It starts to bottom out. Unfortunately, what I've learned is that most people start to understand this. They start to figure it out right as they blow their account. So yeah, the expectation might be that these people lose money and lose a lot of it, but the truth is there are things that we can do to protect ourselves, to prevent the catastrophic losses. Now, there is a very famous individual on TV, who I will not mention, but he says you should never use stop losses. That is the definition of idiocracy. You have to use stop losses because a company can go from wherever price it is right now to zero. Look at Enron, look at WorldCom, look at Exodus Communications, and many, many others. And for those of you watching what's going on in California right now, look at PG&E, right? You might have bought that stock at $70. It could go to zero by the end of the year, the way that they're going out with these fires and lawsuits. So what can we do to stop those slides when we are in a massive negative spiral, which I could call the downward spiral? How did I stop my slide? Well, number one, stop losses, right? Put stop losses in place. Make sure that you implement those so that you never take a catastrophic loss. And that might be per trade. You have a certain amount that you're willing to lose, or per day, or even per month. Also, trade plan. If you don't have a trading plan, there's a very great phrase that says, if you don't know where you're going, any path will take you there. So we are huge advocates of writing out a trading plan. And when we talk about trading plan, it's really twofold. Number one is, what is my philosophy on financial markets as a whole? What is my approach to it? Am I a long-term? Am I a shorter term? The second, and what are my tactics and strategies, my risk management, my money management? And then the second part of that trading plan is, what do I do on each specific trade, right? When I'm mapping out a trade, let's say tomorrow I want to trade the Euro Japanese yen, and I will map out my entry, my stop loss, my targets, the reason why I chose that specific security. But I want to make sure that when I'm in there, I have all of these factors written down so that it keeps me pointed in the direction that I want to go. Those that don't do that are generally shooting from the hip. They're generally doing different things every time they trade. And what that leads to is inconsistency. You won't be able to figure out what you're doing wrong, how you're doing it wrong, or more importantly, how to fix it. So that's the trading plan side of it. Risk management is paramount. One of my favorite guests on Power Trading Radio is Craig Weil, and he was talking about how he's not a trader. He's simply a risk manager. And this is a guy that's been trading for 40 years on the floor of the Chicago Mercantile Exchange. And you're thinking, you're a trader. He says, no, I'm a risk manager first and foremost. And when you hear someone who's done this so long and is their job to trade in the financial markets, you want to listen to him. Risk management should be probably number one on this list. One of the other pieces that's helped me, and which is why I still align myself with Online Trading Academy and I love what we do, is coaching. It's having somebody who's been there, done that, seen it, point at you and say, hold on, you're making that same mistake that I made. Now, take a step back right now from the discussion that we're having on trading and investing and think about your personal life. If you have a career or a profession, there are mistakes that you have made in that profession that I guarantee you somebody else that you know in that industry would have pointed at you and said, why did you do that? I could have told you not to do that. That's where coaching and mentoring comes in. Having somebody there to sit and watch and see what you're doing right, see what you're doing wrong, and hopefully fix those things. These are kind of 5 simple elements, and there are many more than this. These are the high-level ones that will not only stop that learning, that slide in your accounts, but help level it out and then get you back to that point where you want to get to, which is obviously the profit side of it. Now, Shivansh says, fear of losing it all. Look, we could obviously throw in the fear equation here. It's not just the naysayers out there that are saying you're going to lose it all, but maybe your brain is saying, hey, I'm going to lose it all. Okay, that's a very valid point, and I'm glad that you sent that one in. Thank you for that. When you have that fear, one of the things Dr. Woody Johnson will tell you, and I would encourage you to check out his program with Online Trading Academy and the XLTs, is you have to understand your personal weaknesses and fears. If one of your fears is that you don't want to lose any money, then trading might not be for you, because you always have to understand we are going to lose some money. The key is how much. And again, the stop losses help us define that loss. I'll give you an example. I have a per trade, when I'm day trading, I have a per trade stop loss of $250. For the day, and while I'm day trading, $500 is my maximum stop loss. And you're thinking, well, that might be too much for you or too little for you. Here's why I chose it for me. Because I don't want to lose, just like the individual Shivanesh said, I'm a fear of losing it. Yeah, I don't want to lose money, but I know it's part of it. It's kind of like driving down the road. I don't want to hit a red light, but I know I'm going to eventually. It's part of what we do when we drive. So I found a number for me that is not going to be detrimental or make me feel angst and pain and get emotional. If I lose $500 in a day, look, I'm not happy about it, but it is what it is. If I lose $2,000 or $3,000 or $5,000 in a day, I'm a changed person. I'm now emotional. I'm getting frustrated. I'm angry. I really don't want to be around anybody because I'm a jerk. So I want to make sure that that number that I chose is small enough. For you, it might be $100. It might be $1,000. I don't know. You have to define what that number is. But Shivesh, glad you put that one out there. Okay. Let's keep going. One of the other expectations, and I love this one, honestly. This financial industry is wizardry, right? It's like a magician. It's like David Copperfield in Vegas. He's making you look over here at this hand, but the real magic is in the other hand. The financial industry is no different. One of the expectations that we have been force-fed, shoved down our throats since we were children, is that you cannot do this on your own, right? That these financial markets need to be monitored and executed by professionals, that you need to have a broker out there to do this all for you. I love this one. It is really ridiculous that this is such a prevalent perception out there. So what's the reality? The reality is this. Brokers have a Series 7 license, which tells them to what? I'm asking all of you right now. Type in the chat, what do you think a Series 7 license allows your broker to do? Does it make them an amazing trader? Does it give them a propensity to understand the financial markets better than you do? Does it mean that they have more experience and make more sound decisions than you do? Write in the chat. What do you guys think a Series 7 license gives your broker the power to do? What does it let them do? I'm going to wait a couple seconds so I get some feedback in here and see what you guys think about this one. So here's the deal. Back in the late 90s, I was, Angelo says, to rob you. Okay, maybe. Interesting that you put that. I will incorporate that in my answer. So Deborah says, sell for their pockets. No, my wife has one and she could sell annuities. Okay. Predict just like anyone else. Good one. Cover their backside. Okay. Good one. Allows them to buy and sell. Yeah, you guys are right. And some of you guys are cynical like me. Randall says to steal. I love it. It's a very difficult test. But all a Series 7 license does is it basically lets the people who are taking that test understand that here's how you can trade. Here's how you execute on options. Here's the things how options work. It's the basic fundamentals of how an asset class works. Of course, we obviously teach that in our classes as well. But it doesn't make them traders. In no way, shape, or form does a Series 7 say, hey, here is a sound strategy, and here's how you apply moving average systems, and here's how you do discipline and risk management stop losses. It basically allows them to sell securities. That's all it does. It doesn't make them any smarter than you. It just says they can now sell securities. And the bottom line is, it tells them what they can legally say to you without going to jail. That's the Merlin Rothfeld twist on what a Series 7 is. And if you look at what the test is, it really says, here's what you can say to a customer. You can't say this. So really it's saying here's what they can say to you and sell a product without going to jail. So it doesn't make them any better. And it goes back to the point that you need to have a broker. You absolutely do not need to have a broker. Here's what a broker does. A broker is going to get rich off of you. A broker has nice watches, nice cars. Their job is to dress nice and generally impress you with their flashiness. Now, I know that I might be offending some of you who might have family members who are brokers. They are just salesmen. I apologize if I sound so crass, but they're just salesmen out there. And they're going to get paid. We know that in most organizations, the salespeople generally get a lion's share of profits out there, a lion's share of the money. So take a peek at the impact of fees for a second. If we imagine we're getting involved in the market. So let's say you put $10,000 in just deposit $10,000 into an investment account, and you earn that 8% rate of return that we talked about earlier. Now, you're probably not going to find an investment that has no fees, but let's say you bought into something like, IWM, which is the Russell 2000 ETF, or SPY, which is the S&P 500 ETF. They have a fee involved. So let's say it's a 0.2% fee. At the end of 30 years, that account would have grown to, I'm going to just keep the first three numbers, $647,000 and change. But a broker is going to take fees, right? So let's say that they're a nice broker, right? And they're only going to charge you 2% fees. Wow, what generosity out there. You'll notice that that's already shaving your profits by about $180,000. That's $180,000 that goes to the investment firm or the broker simply because they put your money in the same investment that you could have put it in. Now, what if you're in some mutual funds that have load fees? Let's say it's a 5% fee. All of a sudden, that's $378,000 less than you could have had by doing it on your own, right? As Sam says, this is a great one. He says, nobody cares about your account but you alone, right? Nobody cares about it more than you do. So don't let somebody else be in charge of it, because if in a bull market, they're going to take their fees, and in a down market, they're going to take their fees as well. Now, for those of you who've been trading and investing long-term or short-term, you know that there's this learning curve, and this is for anything in life. This is not to depict your account value growing, just the roller coaster of experience, and that's what the shaded area is thinking that's your experience. And at the beginning, a lot of people start off trading. They might make a couple of trades, make some money, and all of a sudden they think, oh, wow, I'm great. Joseph, I didn't mean to offend you. You're like, my wife sure cares. I know that many of them care. I know that many of them are looking out for the best interest of the customer. So that's good. But they are taking a lot of fees out there that we could do on our own. Part of that roller coaster ride is the markets have this unbelievable ability to give you money very quickly at the very beginning, right? So you might, let's say you took an online trading academy class and you come out right away and you're thinking, wow, they made it really sound like challenging and I really need to be disciplined and practice and practice and practice. And you make your first trade and boom, you kill it. You get a 10-to-1 reward on it. You're going, wow, 10-to-1? My instructor made it sound challenging, like 3-to-1 was tough. I'm gonna kill it. So all of a sudden you grow and grow, you have a couple of nice trades in a row, and then the market goes, okay, I got him. Hook, line, and sinker, right? And that's when they just rip your money out of your pocket and your account just goes to zero. So this roller coaster ride is all about experience. The longer that you do this, the better you're going to get, as long as you don't lose your capital. So going back to the reality earlier, which was how to slow down our losses if and when we get there, implement risk management, implement stop losses, make sure you have coaches and mentors and a trading plan so that when you start to get these dips that you see on this one, they will be much, much smaller, and then those rallies become much better. And of course, that means our accounts are growing. That's the whole goal, is just don't lose money. All right, let's go back to a Twitter poll here. We had a Online Trading Academy Twitter poll. You can see true or false, markets always go up. I love this one. This one is a very interesting one because it's kind of a trick question, right? 77% said false. 23% said true, that markets always go up. You're both right, kind of, right? Let me explain. The expectation is that the markets only go up. Okay, here's 1915. This is the Dow Jones Industrial Average from 1915 to 2019. Now, of course, when we look back historically, yes, this one has gone up. And it's not that it was just the buying pressure out there or supply and demand. It actually has more to do with architecture. What do I mean by that? These markets are like a football team. They are, in reality, they are built to go up. They are built to win. unless you're the Cincinnati Bengals or the Miami Dolphins. Then you're just built to lose this season. But anyway, they're built to go up. Let me give you an example of why markets are built to go up over time. And when I say markets, I'm talking about an index, not individual stocks, right? Some stocks will go up for a long time and then they peter out. There's a business cycle, so we have to pay attention to that. When I say market, I'm talking about the basket of securities as a whole or portions of it, like the S&P 500, the Dow Jones Industrial Average, NASDAQ, Russell 2000, etc. So let's take a look at the Dow Jones Industrial Average. Now this is going to go back into 2013. These were the components of the Dow Jones Industrial Average in 2013. So what happened was Alcoa, which is the double A right here, you had Alcoa, you had Bank of America, which is BAC. Where's Bank of America on here? BAC, I might have it wrong. And Hewlett Packard, they were replaced by a couple of companies. So let's see which one swapped out. What they did is they replaced those and put in these new companies, right? Actually, we have it slightly off. Nike actually replaced Bank of America, but you guys get the point. They removed, Alcoa. They put in Goldman Sachs. All right. Then all of a sudden in 2015, for whatever reason, they felt that AT&T was no longer a winner, no longer a key player to the team, and they replaced it with Apple. Nice timing if you're looking at charts of Apple. Might have been a little bit earlier there too. Now, if you look at the most recent change, GE, love the slogan, we bring good things to life. Well, if you're a GE stockholder, it sounds like they're putting their share price to death. GE was replaced in June of 2018 with Walgreens Boots Alliance. Now, for whatever reason, whatever that selection criteria is they chose Walgreens because it's maybe newer, it's got better growth prospects, it might be trending better, but it's like a football team. They're taking players which aren't holding their end of the deal, getting rid of them, and bringing in new ones. So, yeah, technically these markets are built to go up over time. The key here is to not fall victim to thinking that they always go up, right? That's the big challenge, especially for those of you who've been holding long since 2009. You know that they don't always go up. That was a good choice, knocking out AT&T. Yeah, right? Okay, so I real quickly just wanted to show you the Dow Jones Industrial Average. This is going from 1962 to 2019. And I'll run through these real quick. I'm not going to read all these numbers. What I want to illustrate here is when we have a huge market rally, there's generally a significant market correction. And some of them are pretty big. You see there a 46% slide, and all of a sudden in the next few years, it rallied 80%. Well, this happens over and over and over and over again in the financial markets. And we are in a period right now where we've had some pretty significant market moves followed by major market corrections. And if we look forward to where we are right now, I think you would all agree that it just seems like this is setting up for a pretty significant market correction because it's just gone higher and higher. It's probably easier to view this when you look at the S&P 500. And this goes back to 1994. We had this huge market rally from, I would say, 94 to 2000 of 250%. And all of a sudden, that market in a 2-year period fell 50%. Well, that's okay because it rallied 105% over the next 4 years. And then in a year and a half, we dropped 57%. And here we are today, up over 350%. So, those that say markets always go up, you are technically right from an index perspective. Over time, they will. The question is, can you ride out a big market downturn? So, right now we're at that period of time where we're very lofty prices. We're kind of at an uncertain point. We have a lot of factors that might be negative. There's certainly a lot of positive factors out there. But just look at where we are with relationship to the curve, right? Where are we in the big scheme of things? We're pretty overinflated. So for those that say markets only go up, I think we're headed for a period where markets markets will be going down. And that could be the tune of 30%, maybe 25%, 40%, who knows? But just be ready. I'd hate to see people buy a ton of money or buy a ton of securities and then have things slowly start to drift down on them, and now you're waiting another decade for it to come back up into positive territory. Okay, let's talk about, Ronaldo says draft picks, right? Or you spend a lot of years picking the right players, right? And I'm a 49ers fan, so I can gloat today. I'm going to run through real quick some of the ones I've heard over the years with regards to specific asset classes. This is expectations versus reality. And there are a lot of things that are said about different asset classes, some of which are very true. Unfortunately, given the time of this webinar, I don't have a lot of time to dive deep into them. So let's start off with the stock side of things. Now, one of my favorites is the Ward Leave It to Beaver is, I'm going to own a piece of the company. I'm going to own a piece of Apple, and I get to vote on company issues. Let's vote on who the directors are going to be and the executives. Really? The reality is you own a microscopic part of the company, and your vote is insignificant. It means nothing. I'll give you an example. GE has 8.7 billion shares. Let's say you bought 1,000 shares and you're thinking, oh man, I have 1,000 votes. I'm going to make a difference. I'm going to steer this company down the road to prosperity because I know best who to elect for those different company positions. Good luck. There's no chance that your vote would influence that at all, especially when you have a hedge fund who's got 500 million shares or 1 billion shares out there. So yes, you're owning a piece of the company. Yes, you might get a slight little dividend payment if that's what you're into. But really, it's not about company ownership anymore. And I think most of us would agree. We're really buying into these securities for two reasons. Number one is that we are going to be gaining on market appreciation prices if we're long, or if you're short, gaining on those prices of the security share price dropping. Number two is some people like to look for the dividends to get that income stream out there, which is also a viable way. But really, don't think about your owning a company out here anymore. All right, second expectation here, I kept two on equities, which is, I wanted to put this one out there because a lot of people have made comments about these markets being expensive. Here's an expectation. Stocks are expensive and take a lot of money to get started. Well, the reality is this. If you want to be an active trader, a pattern day trader, you need to have more than $25,000 in the account. You can also get started with $1. I know I'm going to leave that hanging in the air. You're like, $1? What am I going to do with $1? Look, you have a lot of sources now where you can, like I believe a company called Acorns, you can take a couple cents and it will buy fractions of shares out there. So it's a way for you to get started with a little bit of money. Now, granted, I think that there's a lot of problems with those types of investments, especially the fractional shares, because you don't really own anything at that point. You have a ledger entry at that company, but you can get started with very, very little money. If you want to be active, though, you should have over $25,000. Sam says corrections are great opportunities to buy calls. Yeah, right. They're great opportunities to buy puts as well when you have the correction coming. But again, Sam, you're absolutely right. It's about knowing what do I need to do when, right? I think that the whole trading world should be a flow chart of if-then statements. If this happens, I do this. If that happens, I do this. A lot of people become buy-side bias, and this is the reason I wanted to show that expectation versus reality is because a lot of people hold on to that belief that markets only go up. And I believe a gentleman in here earlier, Sam as well, was saying 13 years waiting for value to get to break even. Yeah, if you were in the S&P 500 and you bought and held in 2000 as Worth Magazine's cover said to do, Worth Magazine said, why are you not buying? Get in the markets now in March of 2000, right? Look at the chart of 2000. That means that you waited for the markets to come all the way back up to that same level on the S&P, the same height. It took from 2000 to 2007. It kissed it for a couple of days and then fell off again, 57%. And then another few years. Basically, it was 13 years for that price level on the chart to be broken again. That's wasted time and money. Don't do that. So our next expectation here is that futures is the easiest way to make a lot of money. All right. Well, I'm not a fan of this one because what it does when you say that you're looking to make a lot of money and easy, that means you're a gambler. And I saw earlier we had a gentleman out there from Vegas. If you want to gamble, go to Vegas, right? At least you get cocktail waitresses and skimpy skirts and giving you free drinks. The reality is futures can give you great leverage. You can make great money, but that's a double-edged sword. If you're trading any asset class, spot Forex, you can be trading options, you can be trading CFDs, whatever, if there's the potential to make great money, you have to understand there's a potential for great losses. It cuts both ways, which is why we're such sticklers here at Online Trading Academy about trading plan, risk management, and stop losses so that we soften the blow if anything does go against us. All right, what's our next one? Bonds. Oh, I love this one. If we have any seniors in the crowd right now, your financial advisor has been telling you that, you know what, as you get older, you should be involved more in the bond markets because of the stability of the financial institutions that sell the bonds. Therefore, bonds should be a major portion of your portfolio. And to make it easy for you, Mr. Rothfeld, what we will do is we will take your age and we'll subtract that from 100. So, Mr. Rothfeld, you just turned, I don't want to say my age because I'm embarrassed how old I am. Mr. Rothfeld, you just turned 25. How about that? It's easier. We're going to subtract your age from 100, and that's the percentage of your portfolio that should be in stocks. So if you're 25, you should have 75% of your portfolio in stocks. But if you're 75 years of age, you should have how much in stocks? 25. The rest in bonds. So the older you get, the more they're going to push you to be in bonds because it's a safe investment. If you follow what's been happening since we started doing quantitative easing 1 and 2 and 3 and Operation Twist, and now it looks like quantitative easing part 4, this is a manipulation of the bond market. They're inflating bond prices. Couple that with the fact that there's $17 trillion of negative yield bonds in the world, and the U.S. has positive ones. Who's coming to buy our bonds? The rest of the world, which is going to drive bond prices up and yields down. So right now the reality is, it depends on what kind of bonds you buy. You may be buying bonds that have negative yields. Why on earth would you do that? Okay? They can be extremely risky, and as many in my circle of friends believe, there is a bond market bubble, right? There is a bond market bubble that is going to pop at some point, just like there's a housing market bubble and an equity market bubble. We don't know when they will pop, but they will, and hopefully we're on the right side of that one. All right, options. This one is a common one, that options are complex and hard to understand. I think anybody who's looked at options would say that. And if you look at that from the trading perspective, think of it like this. If you speak English, you know, going to learn something like Spanish or Italian, it's challenging, but once you learn the mechanics and have someone show you the basics, it's really not that hard. So it's all about education. Right? If you find that something is difficult and challenging in the financial markets or in life, period, you get education to make that subject matter not so challenging. I can assure you that trading options is not like biochemistry or rocket science. It's just simply basic math. So that's an expectation of reality I think is an easy one to break. Just let's learn the right way to do things. Last one here is Forex. I get this one all the time and it cracks me up. This is a comment I got a couple months ago on Power Trading Radio. I live in America. Forex doesn't impact me. Oh boy, really? If you make that statement, then you're kind of ignorant to how Forex markets work, because the reality is this. Anytime you travel outside of our borders in the U.S., and this goes, I know we have a bunch of people that were from different parts of the world. Anytime you travel outside the borders of your country, you are trading Forex, period. Anytime you buy a product that has been imported, and I'm looking around the desk right now, and I can tell you that this little USB thumb drive, not made in America. Therefore, Forex markets. I've got an iPhone right here. Pretty sure not made in America. I'm paying Forex. I've got a pen. Pretty sure. As a matter of fact, I don't think there's anything in this room that's been made in America. So I'm a Forex trader at heart, right? It's all about market timing. I'm not even made in America. I was born in Germany. I'm a Forex. I'm a currency. So bottom line is, it's not only is it important that we understand Forex, we all are trading it at some point. However, when you look at the Forex markets, they're massive. And the influence they have on a lot of the other asset classes is significant. Really, the two most powerful ones that we talked about of these asset classes right now would be the bond market and the Forex market. Yet most people don't trade those asset classes, right? They're trading stocks, or they're trading options or maybe futures. But the bond market and the Forex markets are massive. They steer global economies. And that gives us opportunities to capitalize on an opportunity or a situation in maybe Europe, maybe in Russia, maybe Japan. We can do that with the Forex market. So don't ignore the Forex markets. They're a great asset. All right, our final poll here. The trading investing is only for the rich and the powerful. I found this one interesting. The 12% agreed with that statement. 88% disagreed. I strongly disagree with this one, because anybody can get involved with it. I think that we've been led to believe this from the early days, that only the rich can make money off the financial markets. Let's look real quick at capital requirements for some of these different asset classes. This may also be a surprise to many of you. If you look at stocks, right, you can get involved with stocks probably for less than $1. I know it seems crazy, but yes, you can with this fractional share purchasing stuff that they're doing now. Now, we obviously don't recommend that. You're not going to get a rate of return, right? You're not going to turn your dollar into 10,000 by Friday. Come on, that's crazy. But if you do want to be active and use the equity markets to grow your wealth, generally what we're looking at is you want to make sure that you have at least $25,000 or more in your stock account. Kenny sent in a nice comment here. I know I'm going back and forth, but I'm trying to monitor the questions and read them at the same time. Yes, Dwayne. Herr Rothfeld. Kenny says, is the term junk bonds self-explanatory? Yes. To a point. Okay, think of this. The risk-free rate for bonds is treasuries, government-backed securities. And of course, we could all make our assessments whether we think our government is going to be around or solvent. But that's the risk-free rate. That's like the safest place because the government will just print more money and back it up. But as we start to get to sketchier bond issuers, so let's say it's a utility company, right? Those are generally fairly safe. The yield might be a little bit more. Now let's say it gets to a company like Apple. Well, fairly safe company. They'll probably pay a little bit more, but not much because it's a stable company. But let's say we go to a company like Tesla, okay? Tesla is still a large company, but very risky, right? They are on shaky ground financially right now. So what do you think they're going to do? They're going to pay you a much greater yield on those bonds because of the risk involved. A junk bond is simply a company is very, very risky. And a junk bond is really a rating. So once you go below a certain rating, and I won't go into it now, they consider it to be a junk bond. And that basically means that there's a good chance they could default on that bond payment to you, right? The company could go under. If that happens, you could lose everything. So a junk bond is somewhat self-explanatory. Just remember that if you're in junk bonds, and there's an ETF out there called JNK, which is a junk bond fund, you are taking greater risk, but you're also rewarded for that. Like I said earlier, you're not going to take on more risk without getting more reward and vice versa. You're going to have much greater reward for that because the premiums or the yields they pay is much, much higher for junk bonds. But the risk is some of those may go default. All right, futures. It depends on the brokerage firm you go to, but generally the minimums can be about $2,000. We recommend having more than 10, and the reason for this is you want to always have a buffer for yourself, right? If you're trading 2,000, that might use up all your capital to buy one futures contract. So you want to be careful there. When we say minimums, I'm just showing that you don't need to have massive amounts of capital, but we definitely recommend that you have much more than that 2,000. Bonds, right? Generally, the par value is going to be $1,000, so that's kind of the minimum out there for bonds, unless you start trading bond ETFs, which can be less. We do recommend if you're going to be in the bond market, go higher. Again, you want to have yourself a buffer, and that goes for these other asset classes. Options. Some firms will allow you to open an account for less than 2. Some are more than 2. We recommend a $10,000 or more account for options. And finally, for Forex, look, there's firms out there, you can open it with $100, you're right, and trade micro lots. Well, you want to have something like 5,000 or more that allows you to trade full lots, although at the beginning, we certainly don't want you to be trading full lots, right? If you're just starting out, you want to trade as small as possible. You want to trade the smallest increment that you can. If you're trading stocks, right now, all these brokerage firms just went to no commissions. So trade one share at a time, right? Who cares? It's not about making money at the beginning. It's about having a skill set, right? Having a strategy, like we talk about Online Trading Academy, our core strategy, taking that, applying it, and doing it in a very small environment so that if you do lose and you are wrong, or you do apply it wrong, you don't lose much and it's not as painful. As you start to develop consistency, then you can start to get bigger with your share size, your lot size, or contract size. Okay, I wanted to put this one in here, and this is not really, it's not an expectation versus reality. It's just to show you the reality of these different asset classes. Now, I have to put a little asterisk on some of these. Down at the bottom, you see that says ETFs. It's generally going to be your lower risk. That's because of the diversification side of things, right? For micro futures, it's 1/10 of a normal contract, Kibwe. 1/10. With the ETFs, we're talking here like SPY, IWM, QQQ, DIA. These are the major ETFs. You can even use, XLF or XLE. They're diversified baskets. There are some that are not diversified, and those in turn do bring in more risk. For example, GLD, right? That represents one security. Therefore, it could be very risky. But in general, ETFs are going to give you lower risk because of the diversity. And generally low volatility as well. As you move up, you have the equities, and of course, we know that there's some stocks that are very stable and don't move much. There's some that are incredibly volatile out there. If you've been watching the earnings announcements of some of these companies after hours, they're wild movers. We move up to options, which I think are probably the most powerful tool out there out of all of these asset classes because of their flexibility. It's the only asset class on this pyramid where you can make money in up markets, down markets, and sideways markets. Futures starts to get on more risk. Now, of course, we know there's a spectrum to futures, right? I could be trading index futures like the S&P, NASDAQ, Dow, and Russell, which I'm going to say are probably the safer ones. I could go into more volatile stuff like crude oil or gold futures or some interest rate products, and now you're dealing with a bit more volatility and liquidity issues. Forex. The reason we have Forex near the top here is because of the leverage, right? For the U.S., you can get 50 to 1 leverage for your Forex. With international markets, some of you guys get to 500 to 1, which is crazy to me to do that. That's a wild one to go out there and be trading, 500 to 1 margin, because you're wrong, you could lose all your account in one shot. And then I put as the apex here just cryptocurrencies because of the extreme risk. I mean, you saw some of these things moving 10, 11%, just a matter of minutes. Very dangerous. And I think that when we construct a portfolio, you kind of want to look at that pyramid and think that's how things might need to be allocated. If you are even thinking about crypto, guys, be very careful and use very small amounts. That is a dangerous asset class. Okay, last part here. I want to go into black box systems. The red light, green light. Now, this is one that many people have talked about, maybe you've heard about, and many people got rich selling to the retail investor a black box system where basically it's a software and you buy this little piece of software and a green light tells you that you type in a security, it gives you a green arrow or a green light, you buy it. If it gives you a red one, you sell it. Oh, it's so simple. The problem with this is it basically makes you the dummy in the equation. What do I mean by that? What it means is it's using a strategy, which if you knew the strategy, you could do it yourself and save yourself the cost of buying that black box system or software. One of the common ones is this. If the price of a security moves above its 10-period exponential moving average, then you buy it. And you're going, that's it? That's it. Somebody basically put that formula behind this red light, green light thing and made millions and millions of dollars selling it to unknowing investors. Shame on them, shame on the investor, who knows, don't point the finger, just understand how this stuff works. So the other side of this is if your security drops below the 10-period exponential moving average, then you sell it. Here's the problem. What type of market does this work in? Right? That simple black box system I just described to you, which is for sale right now, you can go buy it. I would really be ashamed if you went out and bought this stupid thing. But what type of market is that designed to work in? It's designed to work in a market that's been trending. Well, if you look at our markets right now over the past few months, there's a lot of chop. Now, there have been some nice intermittent trends, but there's been a lot of sideways back and forth action. So in a market that's choppy, that is range bound, that red light, green light system is going to destroy your account. You're going to just do nothing but spend money on transactions and lose money on the trades to begin with. So the question is, Sam, it's actually for both. You can do them for both bullish and bearish markets, but it has to be trending strong up or down. So the question is, well, Merlin, are there black box systems out there that work? Is there a system that basically I could just let the computer trade for me and make money? The answer is surprising to many of you, is 100% yes. There are systems out there that will sit there and just trade markets and make money just about every single day. The rub is this. You will never be able to buy them, ever. If you can buy them in the retail market, if you can buy a black box system on the retail market through some website or through some brokerage firm, it doesn't work anymore. Because if I have a system that's pretty much, well, we'll say 95% going to generate me profits, why would I ever want to sell it to you? There's no way I would let that out to you. So a lot of times they're just bundling moving averages or Bollinger Bands or stochastics or some combination of those with volume and time bars and packaging it and selling it. So don't fall victim to that one as well. There's a lot of really shady things that people will do to sell to you. I'll give you another example. I was not involved, but I knew of a guy who was actually trying to compete with our Texas Online Trading Academy. And what he did is he went into a platform which allows you to backtest strategies. So what he did is he backtests the strategy and he configured things so it spit out a number. And basically you can keep tweaking this until it makes you the right answer and you get a ton of money. So he had made $100,000 off a $10,000 account in 1 year. And you're going, whoa, I want that, right? If I could take a $10,000 account, make $100,000 on that in 1 year, sign me up. The truth of the matter is he never made any trades, not one trade. He simply said, going back historically, I'm going to tweak all these inputs and I'm going to have it spit out a number for me. And that was the best number he could. And he tried to start a school doing that. That is shady stuff. A lot of people will do that. There's a lot of people that give false expectations, false claims. If somebody's telling you that they're making 30, 40, 50% a year, ask them if it's consistent. Ask them to show you the trade records and say, the average is 8 and most people don't beat the markets. How are you getting that? All right. Last piece here, I want to just real quickly give an expectation on an understanding of different asset classes and time and duration. There's a matrix that I built many years ago that helped me understand how I need to look at these markets and adjust my trading accordingly. And some of you are going to fall in one of these 3 categories. Let's talk about day trading first. This is you're in and you're out by the end of the day. You're not fooling around. Duration, you're talking short term, guys. This is minutes to seconds sometimes. Probably not seconds anymore, but very short duration. Your size is generally going to be very large because you're not in it very long. You're not trying to capture, $2 or $3 per share. You're trying to capture 10 cents. Stop losses need to be extremely tight. Why? Because your share size is so big. And generally, that means that you need a lot of capital. For those of you doing swing trading, which is generally going to be something that's going to last a couple of days to maybe a couple of weeks, the duration is a little bit longer. Your share size can drop because now you're looking for bigger moves. You're not looking for 10 cents. You might be looking for $1 or $2. Stop losses get a little bit bigger, proportional. And then capital, it's all medium, right? You need a little bit more, you need a little bit less than day trading. For the longer term, guys, your duration, obviously long term, you're talking months to years. Size of your trade, very small. You might be trading 100 shares of a security, but you're trying to capture 10 or 15 points on it. Great. Stop losses for this reason are not long. They have to be large. You have very large stop losses here simply because of the time that you're in the trade and the fluctuations you need to let prices give. And lastly, your capital here. I put medium just because you don't need a ton of money to be a position trader, but you are locking your money up, and that's one of the risks of that specific style. So I've covered a few things here. We could go on and on and on about myths and realities and expectations, although I noticed all of a sudden our time was getting a little bit long here. So what are our next steps for this? Well, it's fairly simple. Your first step is to learn how the markets really work. If you hear something out in the industry that's sensationalized or you have a question, we love answering those questions for you, right? Go to your instructor at Online Trading Academy, bring that comment, or you can bring it to me at Power Trading Radio, and I will break it down. If there's something that you've seen that you think is too good to be true, it probably is, but I'll tell you how a lot of the stuff really works. Number 2, set realistic expectations. When you're doing planning for your retirement and financial future, look at it from an 8% rate of return. Now, of course, if you're planning that starting in the next few months, you got to be careful because we may have a period where we spend a couple of years going down, and that could really impact your rate of return. But 8% is a realistic expectation over time. And more importantly, your next step, which I'm hoping all of you are doing, I think we've got a lot of Online Trading Academy graduates in here. For those of you who are not, you should spend the rest of the day or this weekend building out a plan for today. What are you going to do and change right now that's going to impact your personal and financial growth? How are you going to implement that tomorrow and let tomorrow be that step that starts to build it even more? And then ultimately, it's about setting targets. It's about setting goals. It's about setting objectives for retirement or even further down the road. And how do we plan for that and make that a reality? So I'm hoping that you guys got some good information out of this one. I saw a lot of great feedback from many of you out there. So thank you so much for the feedback. Appreciate it. If you have questions, I'll stick around for another minute or two and answer those. If not, I will take some of the questions and answer them on Power Trading Radio. What I recommend for all of you, if you found some of this interesting, you would like to learn more, you would like to learn, go to a free workshop on how market timing works and how we have a patented strategy on it, what it might mean to you, I would go to otawebinar.com. You can go there and register for a half-day class and find out more about how we can potentially help you change your financial future. So that said, everybody, thank you so much for joining us today. We'll see you next month for another great webinar, and thank you for all the participation. Take care.